Ladies and gentlemen, you are connected to the Star Cement conference call. Please stay connected. The call will begin shortly. Ladies and gentlemen, you are connected to the Star Cement earnings conference call. Kindly stay connected. The call will begin shortly. Thank you. Ladies and gentlemen, good day and welcome to the Q2 FY23 earnings conference call of Star Cement, hosted by PhillipCapital India Private Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on a touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Vaibhav Agarwal from PhillipCapital India Private Limited. Thank you, and over to you, sir.
Thank you, Rutuja. Good morning, everyone. On behalf of PhillipCapital India Private Limited, we welcome you to the Q2 and H1 FY23 call of Star Cement. On the call, we have with us Mr. Tushar Bhajanka, Executive Director, and Mr. Manoj Agarwal, CFO of the company. At this point of time, I'll hand over the floor to the manager of the company for their opening remarks, which will be followed by interactive Q&A. Thank you, and over to you, Manoj, sir.
Hello. Yeah, hi. Good morning, all. My name is Tushar Bhajanka. I am the Executive Director of Star Cement. I'd like to welcome you all to the earnings call of Q2. I have Mr. Manoj Agarwal with me, who is the CFO of the company. He will take you through the numbers of Q2, and after that, we can have a Q&A session. Thank you.
Yeah. Hi, friends. Very good morning. I, on behalf of Star Cement Limited, welcome you all to our Concall for discussing our number of Q2 FY23 and half year ended September 22. I would like to clarify that we will be discussing on the historical number, and there is no invitation to invest. Having said that, now I will just take you through the Q2 number followed by half year number. Starting from clinker production during the quarter ended September 22, we have produced 5.11 lakh ton of clinker as against 5.49 lakh ton same quarter last year. So far as cement production is concerned, we have produced 8.91 lakh ton this quarter as against 6.18 lakh same quarter last year. This quarter, we have taken shutdown in both of our kilns at Lumshnong, Meghalaya. Now, I will take you through sales volume. During the quarter, we have sold 8.91 lakh ton of cement as against 6.17 lakh ton of cement and negligible quantity of clinker same quarter last year. This is as far as cement and clinker sale is concerned. As far as geographical distribution of cement is concerned, in Northeast, we have sold around 6.54 lakh ton as against 4.93 lakh ton during same quarter last year. And as far as outside Northeast is concerned, we have sold 2.38 lakh ton of cement this quarter as against 1.25 lakh same quarter last year. In terms of blend mix, it is almost 6% of OPC and rest is PPC. These are the quantitative numbers of the quarter. Now I will take you through the financial. The total revenue figure this quarter is around 593 crore as against 406 crore same period last year. As far as EBITDA figure is concerned, this quarter we have done an EBITDA of around rupees 83 crore as against rupees 80 crore last year. That is rupees 49 crore as against rupees 44 crore in same period last year. This is on account of increased tax expenses due to sunset of tax exemption period in respect of our company's Guwahati grinding unit and its subsidiary Star Cement Meghalaya Limited. However, the cash outlay will be met only. On per ton EBITDA front, it is 934 during this quarter as against 1302 per ton same quarter last year. This is what our quarterly numbers of this quarter. The total revenue figure for the half year ended September 20 is around 1258 crore as against 917 crore same period last year. As far as EBITDA figure is concerned, During half year ended September 22, we have done an EBITDA of around rupees 221 crore as against rupees 182 crore last year. PAT is rupees 99 crore as against rupees 115 crore in same period last year. PAT is down due to increased income tax expenses as explained before. On per ton EBITDA front, it is 1183 during this half year ended September 22 as against 1317 per ton same period last year. These are the quarterly and half yearly numbers. Now I request all of you that if you have any query, you can ask the same. And I will request Vaibhav to moderate the query wherever it requires. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, to ask a question, you may press star and 1. The first question is from the line of Shravan Shah from Dolat Capital. Please go ahead.
Yeah, thank you. Sir, first on the volume front, so last time we said we are looking at close to 17% growth, that is a 4 million ton volume for this year, and the next year double digit. So the strength remains same or maybe likely to slightly better in this year?
So the volume growth that we've had in quarter 2 has basically been about, it has been about 44%. So we have actually been faring much better than, what we had actually projected earlier. In this, a lot of our growth has come from outside Northeast. So we have grown about 91% YOY in outside Northeast. And in Northeast as well, where our volumes have grown by about 33%. So we do stick to the number that we had earlier projected, and we do expect that the numbers will be better than what we had said.
Okay. Secondly, in terms of the geographical mix, so this quarter seems the Northeast is slightly lower, but we were looking at close to 65% share in Northeast. So will remain the same?
Yes. So I think even if you look at the numbers this time, we have made more than 65% of our sales in Northeast compared to, any of the previous quarters. Of course, the growth in outside Northeast has been better, this quarter, but even the North has grown. So in that sense, we are trying to maintain a 25, like a 75-25 or a 70-30 ratio between Northeast and outside Northeast sales.
Okay, and what will be the number in terms of the trade share for this quarter and lead distance?
Yes, so the trade sales, the overall, so we have actually increased our trade sales to about 93% of our overall sales. This, if you compare it to previous numbers, was about 85% last quarter and 88% YOY. So, so we have increased, so, we have not only led to a higher overall number, we have actually increased the proportion of our trade with non-trade sales. So that proportion on trade sales right now is about 92.4%. And regarding the lead distance has increased slightly from 230 kilometers last quarter towards 233 kilometers this quarter. So it has only increased very slightly.
Okay, so in terms of the premium share this quarter, how much? And we were looking at to increase to 10% this quarter. So for this quarter, has it increased to 10% from 8% in June?
Of premium products. So
yeah,
the premium product sale has not shown that kind of a growth. So it has broadly remained as about 7% of our overall sales, which was very similar to the number last quarter.
In terms of the now pricing, so how the pricing has moved in East and Northeast in second quarter, and post September, how the prices has increased in both the regions?
So, the pricing has broadly remained the same in Northeast. It has probably fallen by 10 rupees, but, not significantly. The pricing outside Northeast has, of course, taken a hit. So if you talk about, North Bengal area, the pricing has fallen by about, 20 rupees in August month. But then from September month, it has been increasing. So even in October or November, we have taken price increases in outside Northeast. So the Northeast prices have broadly remained the same, whereas the prices outside Northeast had fallen by about 20 rupees, but now they have again picked up.
So broadly post September, on an average outside Northeast, the price increase would be how much? 15-20 rupees, both BR and West Bengal?
Sorry, could you repeat that, please?
I'm saying post September, Bihar and West Bengal price increase would be around 20 odd rupees post September.
Yes. So yes. So we had taken a price increase in September, and then the price had actually fallen again in October, because October was not a good month for any of the cement players, because all the festivals actually took place in October. So, but now in November again, we have increased the prices by 10, and we expect that we'll again increase the price of 10 to 15 rupees.
Oh, so 10 to 15 more we are expecting.
Yes, in the month of November.
Lastly, on the expansion and the capex and the date front, so in terms of the timeline for 3 million ton clinker, 2 million ton grinding in Guwahati and 2 million in Assam. So previously we mentioned December 23, January 24 and March 24. So that remains intact, or do we see any delay in terms of commissioning the plant? Because last time we said from August the full construction will start. So has it started? Any update? And in terms of the capex, though this 1H the capex was only 127 crore versus where we were looking at 1,000 crore this year, next year. So what's the new number?
So, so we have, of course, embarked on the capex that we were discussing. Our commissioning of the plant has already started in Lumshnong for the 3 million ton clinker plant. We have also, started our commissioning of the grinding unit in Guwahati. We have started buying, the land, that we require in Silchar for our grinding unit in Silchar. So the capex is going on full front, and we still stick to the timeline that we had discussed earlier. In terms of, the capex outlay, the capex outlay has just started. Overall we must have, in terms of projects, we must have spent about 100 CR. So I think the major, spending which will happen will start from the fourth quarter of this year, and that's where we expect most of the capex outflows to happen.
So 1,000 crore this year we are looking at, and the next year also 1,000 crore capex. And the
this year may not be 1,000 crores, it may be about 700 crores. But it will carry forward to the next. The capex that we don't do this year will carry on to the next financial year, because we do aim that our capacities would come by December 2023 or Jan 2024.
Okay, so and the peak net debt we were looking at 500 odd crore, so that remains intact.
Sorry.
Peak net debt we were looking at 500 odd crore, so versus currently the.
That remains intact. Yes.
Okay, and lastly, if you can help on the power and fuel cost. So in terms of the KKL, how was it for this quarter, and how do we see? Because previously we were looking at 10% increase in the second half of this year. So any color on that?
Yeah, so the power and fuel costs have actually increased. The power in terms of the fuel cost that we had has increased from about 1.5 rupees per GCV that we were averaging out earlier to about 2.1. The main reason for this is, of course, that the FSA contracts that we have are only partially being obliged by the ECL, mainly because of the shortage which is happening throughout the country. So because of that, we had to buy a few rates from spot contracts, which is leading to a higher surge in the fuel cost. And the power cost has broadly remained the same. It may have increased by about 0.5 rupees per unit. And yes, so that is basically the situation that we have on power and fuel costs at the moment.
So in second half, we see further increase by how much in terms of the both power and fuel costs combined put together?
So in second half, we see a basic increase of about 30% in terms of the fuel cost. And the power cost, because we rely on IEX, and IEX is not fluctuating as much in the quarter two, so the price, the power cost has not increased more than 10%.
Okay. Thank you. All the best.
Thank you. Thanks a lot.
Thank you. Ladies and gentlemen, to ask a question, you may press star and 1. Participants who wishes to ask a question may press star and 1. The next question is from the line of Uttam Kumar Srimal from Axis Securities Limited. Please go ahead.
Yes, sir. Thanks for the opportunity. Sir, my question pertains to our WHRS plant. When this plant is going to commission, this 12 megawatt WHRS plant?
So, good question. The plant was supposed to commission by about November, but there is a 1 month delay to the commissioning of the plant. So now it will be commissioning end of December. That is our, timeline, the revised timeline for the WHRS plant. So it should be coming up very soon by next month.
Okay. And sir, what has been our power and fuel mix this quarter? Because last quarter it was around 90% domestic coal and 10% biomass. So it remains the same, or there has been some change in the fuel mix this quarter?
No, so basically last quarter we of course had 10% of biofuel, which we also have this quarter. But the domestic coal was basically coming from the FSAs that we had.
Mm-hmm.
But because the FSAs this quarter weren't obliged, though we were eligible, but we didn't get it because of the shortage which is happening in Coal India. We had to rely on buying spot, auction. We had to participate in spot auctions and buy outside coal at a higher price. And so yes, we have been importing. We have been using the domestic coal, but the domestic coal is coming from a different source than what we had earlier.
Okay, so now this situation is normalized, or still you are buying from outside rather than from getting from FSA?
So we are, we still get whatever we are trying to get as much as we can from the FSA, because the FSA contract that we had was of a 1.5 rupees per GCV. So we are trying to make sure that we get as much as from FSA, but we have to, we have started buying coal from spot contracts other than FSA as well, which of course is coming at a rate of 2.9 rupees GCV to the plant.
Okay, so that's why in third and fourth quarter fuel cost will be higher because you are purchasing from outside.
Yes, so that is correct. Our fuel mix has definitely changed between FSA and auction, and I think the fuel cost that we saw in quarter two will also be passed on to quarter three and quarter four.
Okay. And sir, when our Guwahati grinding unit expected to commission this year or next year?
So the grinding unit, so we are coming with 2 grinding units. One is in Guwahati and the other one is in Silchar. The one in Guwahati is due to be commissioned in October next year, and the one in Silchar should be commissioning by June 2024.
Okay. Okay. And clinkerization plant will be commissioned this year only, the Meghalaya 3 million ton.
No, so the Meghalaya clinkerization plant will also commission by December next year. So there's no plant this financial year.
Okay. Okay. Okay, sir. That's all from my side, and thank you. All the best.
Thank you.
Thank you. Participants who wishes to ask a question may press star and 1. The next question is from the line of Shravan Shah from Dolat Capital. Please go ahead.
Sir, again, just trying to reconfirm because previously when I asked, you mentioned the deadline of all the plants same, but now seems a slight change. So 3 million clinker at Meghalaya will start by?
December 2023 or Jan 2024.
Okay, and 2 million ton Guwahati will start by?
October 2023.
October. Okay, so that is preponed, and the 2 million ton Assam Silchar will be June versus last quarter we were looking at March 24.
Yes, yes.
Okay, and the second thing is in terms of this quarter, in terms of the Siliguri utilization was how much?
So Siliguri utilization this quarter was of about 50%. If you compare it to last year same quarter, it was about 30%.
Okay, and so we were looking at for the full year. So last quarter Q1 was 67, now 50%. So for full year we were previously looking at 65 to 70%. So this would be in the 60 to 65% for full year.
So so I think we should still touch a 65% because we all know that Q2 is the worst quarter that in terms of volume that we have. So Q3 seems better. Q4 should be the best. So in terms of utilization, I think we can average a good 65% or above.
Okay, and on the premium share, just trying to continue. So now 7% share, and so how much increase the premium share, and also previously we were looking at the price gap between the normal and the premium was kind of a 20 rupees, so 400 rupees per ton, and we were looking at to increase this from 20 rupees to 100 to 200. So when that can be possible? Any color on that?
Yes, so I think we have so our shares, we are right now launching policies, and we are giving schemes which would lead to an increase in our shares. We are basically focusing outside Northeast because Bihar has a good market for premium cement. That's where we are trying to push our premium sales. So we can target that by end of this financial year, we are targeting a premium sales proportion of about 11%. And as per the gap, the price gap between the premium and the PPC, right now the price gap is of about 25 rupees. Of that, we have to give about 5 rupees as discount. So the impact on the NOD, the net of discount price, is about 20 rupees still. And we are working towards creating the difference between the PPC and the premium, but we have to follow the market trend. So we have to follow other players as well, and the difference that they have between and the normal PPC.
Okay. And just to get it right, in terms of the fuel mix, you mentioned that the auction coal that you purchased was higher. So for this quarter Q2, 10% you said the biomass. So in terms of the fuel mix, if you can help us, what was the FSA and the spot or maybe the Nagaland coal share?
So this this quarter we had about 10% is still coming from biomass, and we had about 45% of our coal coming from spot contracts, which are higher, it has a high cost, and the other 30 to 35% is mainly coming from the FSA contract, and there is 10% coal coming from Nagaland.
Okay. Okay. Just a second. Yeah. Mostly done. Nothing remains. Thanks. All the best.
Thank you. Thanks.
Thank you. Participants, to ask a question may press star and 1. The next question is from the line of Amit Murarka from Axis Capital. Please go ahead.
Yeah, hi, good morning. So just on the expansion program, just wanted to have some clarification. So the size of clinker is 3 million ton, and what is the size of each of the grinding units?
It is about 2 million tons each.
Okay, and the capex, what's the capex outlay for each of those?
So it is about the clinker plant is basically for about 1,250 crores, and the grinding unit would be about 400 for the Guwahati plant, because that's a brownfield expansion, and about 450 to 475 for the Silchar plant, because that will be greenfield.
Okay. So in total, about close to 2,100 crores capex.
Yes.
Got it. And what is the plan? Like, while you're saying that long term you're looking for 70% northeast and 30% east, but a lot of the incremental expansions are also happening. I mean, at least some of the companies like Ultratech is also looking to be more aggressive in the northeastern market. So do you think that this kind of you will be able to sustain your volume market share and grow these capacities given this inflow of new volumes?
So I think the belief is that we can sustain these margins. Plus, we are actually trying to increase our market share now. The main reason is that the cost of fuel has increased throughout the country. Right, and earlier what we used to, what used to basically happen is that a lot of cement from outside used to be dumped in Northeast, right, by Ultratech or by other players. Whenever they had the capacity or whenever the demand was not picking up in the mainland India. So I think now, because the variable cost has really increased, they're not finding it that profitable to actually dump in Northeast. So from that perspective, I think the higher costs are leading to less of dumping in Northeast from outside companies. So I do not think, and that has been the trend in Q2 as well. So there actually has been less cement coming from outside.
Ladies and gentlemen, please stay connected. The line of the management got disconnected. Ladies and gentlemen, thank you for patiently holding the line. The line of Mr. Tushar is reconnected. Thank you, and over to you, sir.
Yeah. Sorry about that. I was just saying that the arrival of outside companies in Northeast has actually reduced in Q2, and we see a similar trend in Q3 as well. From our perspective of what is going within Northeast, there are smaller players in Northeast which had set up the capacities about 2013, but no one is really expanding at the moment. And I think we'll again get the first mover advantage in terms of expansion, and the 2-3 years that we'll have, where others are still setting up the capacities and we have already set it up, would really give us the advantage to get a higher market share. So that's what we're really aiming at.
Okay, understood. Thank you. That's all from my side. Yeah.
Thank you. Ladies and gentlemen, this will be the final reminder for the questions. Participants who wishes to ask a question may press star and 1. The next question is from the line of Mangesh Bhadang from Nirmal Bang. Please go ahead.
Hello, sir. Sir, a couple of questions. First is on the demand side. We've seen good volume growth for us in this quarter. I just wanted to have your view on how the demand should shape up in this year as well as next year in Northeast, as well as outside Northeast markets for you.
Sorry to interrupt you, Mr. Mangesh, but your voice is muffled and there is a lot of disturbance from your background, sir.
Just hold on. I'll just. Is it okay now?
Yes, it's much better.
Yeah, sir, I just wanted to have your views on what your demand outlook is in the northeastern and eastern region.
So I think, this year the market in the northeast has really supported. So the outlook seems positive. From a northeast perspective, even eastern markets have really grown in quarter 2. So, so I think we are optimistic about how the market is behaving. Of course, we have cost pressures that every company is clearly facing, in cement, and that will remain a problem. However, we are, looking for a good season ahead, and we do think that we will be able to pass on some of the costs in the price. So I do see a good season ahead, and I do expect Northeast to keep growing in the way it's going.
So any number you can assign to the demand growth expectation in these two regions?
Yes, so I think Northeast is showing trends of growing about 10% to 11%, whereas the outside Northeast market is showing a growth of about 12%. And outside Northeast, I just mean the places that we are serving, the area that we serve, which is basically North Bengal and East of Bihar.
Right. And so last year, I think Bihar market, because of the sand issues, the demand was slightly lower. So you think this time around there will be pent-up demand because of that and could see higher number? And even in Bengal, I think because of floods, we had seen that temporarily the demand was lower. So all these effects, would this affect the overall demand growth that could pick up in this year from the low base of last year? Or do you think that 10 to 12% is the number that is basically which is prominent?
Yeah, so I think I do not think that we had the problem of the sand problem that we had last year. I don't think we had it to that extent this year, and that's why the numbers look better. In Bihar, we have actually increased a lot in terms of sales. I think we have increased our sales in Bihar by about 120% this quarter, and that's clearly a sign of the sand issue or the floods issue not affecting us that much.
Okay. Sir, next question is on the profitability in the northeastern and the eastern region. Can you just give a broad outline or highlight how our profitability would look like in these two regions, specifically because I think the next leg, at least when since Siliguri starts expanding to say 70-80% utilization, largely the sales would be more towards outside of Northeast. So if you can give some color on profitability in terms of EBITDA per ton in these two regions, that would be helpful. Any broad guidance would be helpful.
Yeah, so I think because time is so uncertain, it'll really be hard to give a number to it. But we last time we said that we'll like to maintain an average EBITDA overall EBITDA per ton for the company to be about 1,200 to 1,250, and we'd like to stick to that. Of course, it really prices behave. So I would still say that we'll aim for 1,200 rupees per ton EBITDA overall. In Eastern region, we of course earn lower than what we earn in Northeast. Northeast, our margins are about 1,400 rupees on an average, and eastern region, it is about, about 400 rupees to 500 rupees. So of course, the weighted average comes to about 1200, and that's the distribution of our margin between the two regions.
Understood, sir. Thank you.
Thank you. The next question is from the line of Chandresh Malpani from Niveshaay. Please go ahead.
Yeah. Hi, sir.
Hi.
Hello.
Hi.
Yeah.
Hi.
Yeah, so sir, firstly on the waste heat recovery plant, is it commission and what cost savings do we see from this plant?
So, we have set up a 12.3 megawatt waste heat recovery, which should commission by next month. So,
Okay.
and with that, currently on an average we pay price of power is about 6 rupees. So we can actually back calculate, and it should be a saving of about 45 to 50 crores.
Okay. And secondly, sir, what is our dealer network stands as on date, sir? Have we increased our network?
So yes, so we have increased our network, and actually, our focus right now is not that much in outside Northeast. It is actually in Northeast, right? Because there are still many areas in Northeast that we of course can serve better, that we can have a higher market share in. There may be still markets in Northeast where there are white spaces where in those micro markets we aren't serving, and our focus right now is entirely Northeast, because the capacities that we're getting are of course in Northeast. And so, to utilize the capacities better, we definitely have to focus in Northeast. So we are focusing on dealer appointments, and that primarily will be in Northeast.
Okay. Thank you, sir. Thank you.
Thank you. The next question is from the line of Ripam Proto, an individual investor. Please go ahead.
Hello, sir.
Yeah. Hi, good morning.
Yeah, since I'd like to know regarding that coal. You have said you have sourcing from the FSA and also the Nagaland coal.
Uh-huh.
The Nagaland coal belongs to Coal India or some others, and what is the landed cost for the coal?
So the Nagaland coal is actually not belonging to Coal India. It is actually the state of Nagaland authorizes individual mine owners or companies to mine in Nagaland, and we buy through those sources. So they aren't owned by Coal India. They are owned by private individuals or companies in Nagaland. And the landed cost of Nagaland coal is of about 2.05 to 2.15 rupees per GCV.
Okay, sir. And regarding the Meghalaya coal, has any auction been conducted, or till when will we see any outcome of that coal of Meghalaya?
So I mean, that's a very good question. So I mean, we right now, of course, Meghalaya coal is we can't, no one can mine Meghalaya coal because there's no structured mining lease which has been allotted in Meghalaya. But there are individuals who are local to Meghalaya who are applying for mining leases in Meghalaya, and if they are successful in getting those mining leases operated, then definitely coal in Meghalaya will open up, and that of course is a very that could be a very big saving for the company going ahead.
Okay, sir. So right now, no coal.
Hello?
Mr. Ripam, we cannot hear you, sir. As there is no response from the line, we'll move to the next question, which is the follow-up question from the line of Amit Murarka from Axis Capital. Please go ahead.
Thanks for the opportunity again. So, on your current capacity, I just wanted to check, my understanding is you have 2.75 million in clinker and 5 million in grinding. Is that correct?
So we have about 5.6 million tons in grinding, and we have about 2.65 to 2.7 million tons in clinker.
This 5.6 million ton grinding, does it also include some of the tolling arrangements which you had, or this is your own capacity, 5.6?
No, this is our own capacity. Right now, we're not renting out or leasing any other rented, any of the other plants. This is our own capacity.
Okay. So those arrangements are no longer being done.
Yeah. So we had earlier, 2-3 years back, we had a plant in Durgapur, and we had a plant in Siliguri as well. But we stopped supplying to Durgapur, so we aren't serving that market anymore. And in Siliguri, we got our own plant, so we stopped renting the plant that we were renting earlier.
Got it. So you, in the future also, you don't plan to now get into these arrangements with these expansions that they are doing now?
Not really. I don't think we are trying to serve a market where we need to do that. So not really.
Okay. And if I got your EBITDA per ton kind of outlook right, you said that in Northeast you are making 1400 per ton, in East you are making 400 to 500 per ton.
Yeah.
Right. Great. So the lower margin is what large part of it because of the logistics cost, right? I mean, and also the pricing is lower, of course.
Yes, exactly. So it's mainly because of logistics, right? So it's mainly because of logistics. And of course, the pricing outside Northeast is lower than in Northeast. So that also plays a factor. So it's both actually. It's higher logistics cost coupled with lower prices. And it's not lower prices of course, the prices in general outside Northeast is lower. It's not that our brand charges a lower price. We actually charge the same price as UltraTech outside Northeast as well.
Oh, got it. Thank you. That's all.
Yeah.
Thank you. We'll take the next question, which will be the last question, which is from the line of Shravan Shah from Dolat Capital. Please go ahead.
Sir, so continuing the previous question, so broadly, let's say for this quarter, whatever our realization was there, on an average for outside Northeast, what would be the realization, and in the Northeast, what is? So just trying to understand the pricing difference between Northeast and East, what we sell.
So, the difference in realization between outside Northeast would be about, about 1,100 rupees on per ton on NOD basis, netto discount basis.
Okay, so net of GST and everything, what we book in the our accounts, so that difference would be 1,100.
So it will be basically about about 800 to 700.
Okay, 700 to 800 in terms of the what we book in the report in the PNL.
Yeah.
Okay. Second thing, just wanted to understand in terms of the lead distance. So, what the max we can say in terms of the further reduction is possible? Let's say the Siliguri full utilization 65%, and maybe next year if it increases. So, to what extent we can reduce the lead distance from currently 233 kilometers?
So in this, we are expecting that our capacity. So right now also, our main focus is in reducing the lead distance and trying to serve markets closer to Siliguri, because at the point, we are focusing much more on profitable and sustainable growth rather than just selling anywhere and everywhere. So, I think from next quarter as well, you'll see that the lead distance will be coming down, and that will be primarily our focus. I cannot give a number just now about what the future lead distance is going to be, but the focus is definitely to serve closer, to serve to a higher profitable market, and to not go very far in terms of just, for the sake of just utilization.
No, I understand that we can't give the number, but broadly, can it be 10-15 kilometers more than that reduction is possible, or the reduction would be in the 5-10 kilometers only? Just on the full blended basis for us, just trying to understand that directionally.
So again, I really I won't be able to comment on that really, because I really have to do the math. It won't be fair for me to just agree to a number, but we definitely will see a reduction. Is what I can see. But then the lead distance also sometimes increases because of a lot of other things. Sometimes one road is not working and you have to come through the other route, and sometimes lead distance increases because of that. So, and in Northeast that is very, very common, right? Because the road infrastructure is not as good as in mainland India. So it's really hard to comment or promise any number for next quarter, but I think we should be looking at a decent reduction in our lead distance. And then we've already started acting upon it in terms of choosing the right markets and to get out of markets where we are not earning much and not selling much.
Okay. Lastly, sir, the data point on the trade subsidy, how much book in this quarter?
So we don't have any trade subsidy this quarter. For that, I think the CFO can, share better.
Yeah, we don't have any freight subsidy right now because it has been long back. It has been already been there is no freight subsidy because it is for 5 years only and it is gone, all are gone. So there is no freight subsidy in books of accounts.
Okay. Thank you.
Thank you. Ladies and gentlemen, as this was the last question for today, I would now like to hand the conference over to Mr. Vaibhav Agarwal.
Yeah, thank you, Rutuja. Tushar, I had a couple of questions from my end for you in particular. So, firstly, because Northeast is a very kind of a fragment or player market dominated by very small players as well. There are a number of small players in Northeast, and given the consolidation happening in the industry, so do you see any potential of further consolidation happening within Northeast by the larger players? What your comments around that, if possible?
So, I don't think right now in Northeast there is any potential of consolidation. Mainly because the smaller plants. Because I think Dalmia will also be aiming to set up a brownfield expansion. Of course, right now they haven't progressed with it. I don't know of their progression in Northeast in terms of setting up a plant, but they, I'm sure, will aim at setting a plant. Even us, we are setting our own plant, so it doesn't make sense for us to unnecessarily go for a acquisition when our own capacity, which will be much more efficient than the smaller units, is coming up. So I don't think there's any scope in Northeast for consolidation at the moment. So only after we get the capacity and there is some pressure on the smaller units, then there may be some scope.
But do you believe that some of the larger players of the over the pan countrywide players, they would be looking at Northeast as a geography and they would be targeting some of the existing players? Any thoughts around that? Because a lot of capacity is coming from mainland to Northeast now, is what is suggested.
Yeah, I think the trend of actually cement coming from outside Northeast to Northeast is a similar trend of cement going from Northeast to outside Northeast. Whenever we have capacity, it is a tendency to go far out. So I think that is, and this theme has been very common in Northeast for many years. It's not the first time UltraTech is sending cement to Northeast. The trend says that the amount of quantity which was coming earlier from outside has actually reduced. So from them actually targeting Northeast from outside is not possible. Now, if you come to the point of them acquiring a plant or smaller plant in Northeast, I don't think it is very economical for them because the smaller plants are of 0.7, 0.6 million tons. I don't think an UltraTech or an Adani would be interested in something that small. And also the terrain is very different. The kind of problems that one faces of setting up a plant is very different. So I think for them to kind of invest so much time in a smaller plant and then growing it is something which I don't know if it's still worth their time, I guess.
Understood. And one more question with regards to Star Cement in particular. So despite all the expansions and our roadmap to nearly 10 million tons now, we would be in terms of we will be having quite a healthy balance sheet. So what's your roadmap for Star Cement in the medium to longer term over the say next 5 to 7 years? And do you look Star Cement being restricted to only East and Northeast, or you are looking at other geographies? Are you willing to evaluate opportunities, organic, inorganic, across other parts of the country beyond East and Northeast? Any thoughts on that?
So, that's a good question. So, I mean, so in 1.5 years from now, we are planning to set up about 4 million tons of cement and about 3 million tons of clinker in Northeast, right? That will take care of Northeast for our market in Northeast for the next 5-6 years, right? And as a company, we are already very cash rich, and we, of course, with these capacities and the benefits, the policy subsidies that we'll get from these capacities, we'll have an even richer cash inflow. So we definitely have to get out of Northeast and probably target other areas as well for us to use those cash flows in the best possible manner. So we are right now also considering other areas outside Northeast, just so that once our capacities come in Northeast, we can keep on with the expansion phase and go outside Northeast as well.
So any regions which you are currently shortlisting in terms of your future longer-term growth plans?
So, we are exploring, MP, because that, of course, is a natural expansion to where we are. So we are in Northeast, and putting up a plant in MP will definitely help us serve Bihar better. It will also help us serve other areas in East which we don't serve at the moment. We are also looking at Rajasthan because it broadly is part of North India, and North India, of course, is growing at a faster rate. And then we look at other areas as well. It just depends on on what is also available, because there's the availability of good assets in cement right now for something that we can acquire given our size is also limited. So it really depends on what is coming our way, I guess.
So just an extended question to what you just said. So when you're looking at places outside East and Northeast, is it when you evaluate such opportunities, is it necessary for you that they should synergize with your current operations, or are you willing to enter a new geography in all ways possible, or it's compulsory that it should have a synergy with your current operations?
That's again a fair question, right? So I think it just depends on the opportunity which comes, right? We have to evaluate whatever is coming without any bias. Yes, of course, we would have loved if it was a natural extension to where we are at the moment. Okay. But cement is, I don't think the synergy is that strong that we need to bother too much about that synergy, right? Because the market that we will try to enter, by putting up a plant in MP, would be completely new. So any which way we'll have to brand, we'll have to do the entire effort as a greenfield project. So from that perspective, the synergy is fairly limited. So we're not really bothered about that synergy too much.
So you remain indifferent from that perspective. Is it fair to say that?
Yeah.
Okay. Thank you, Tushar. Thank you, Manoj sir. Thank you for your time. Tushar, you can now conclude the call. Thank you very much for all the participants joining the call. Thank you very much. On behalf of Philip Capital, I'll conclude the call. Thank you so much.
Thank you. On behalf of Philip Capital India Private Limited, that concludes the conference call. Thank you for joining us, and you may now disconnect the lines.
Thank you.